Do you know your credit score? Do you even know what a credit score is? If you don't, that's okay. Actually, a lot of people don't really understand how it all works, but we'll get you there because you need to know. Your credit affects pretty much every aspect of your financial life. Your interest rates, your ability to buy a car or a house. It can even affect whether or not you get a job. So let's talk about how it works. There are two parts to it, your credit report and your credit score. And remember, this isn't a finance test. You don't have to memorize a bunch of stuff you don't understand. The idea here is to break down the information in ways that you can understand it. And so it's easier to get. Then you can walk away from here and make decisions you understand and that you're confident about. And to do that, you just need a little common sense. What exactly is credit? It gets kind of confusing because the word credit has two different meanings. So first, credit is borrowed money that allows you to buy stuff and then pay back the money later. Credit also refers to the likelihood that you'll pay back borrowed money and be able to get new loans down the road. So with a credit card, if you charge a bunch of stuff that you can't pay off, nobody else is going to want to let you borrow money from them. So that's credit in a nutshell. Now let's talk about credit reports and credit scores. So what's the difference? Let's start with your credit reports. So a credit report is basically a file that contains all the details and information on all your credit accounts and payment history, even old accounts. So a few examples of this: mortgage, car loan, student loans, credit cards, a retail store card, or medical bills. You get the idea. So let's talk about why it's so important that you check your credit reports. A lot of people don't pay attention because they either don't think it's a big deal or they don't want to face what's in it. Bad idea. You really need to keep tabs on your credit and your credit reports. Here's why. The first reason, mistakes. There could be errors on your report that you don't even know about. Maybe you paid off a bill, but your report shows that you didn't. You want to find any mistakes as soon as possible so you can get them fixed and so they cause less damage. Another reason to check, there could be old bills you never knew about or just forgot about. Maybe you had a bill from a doctor or a retail store and you moved away so you never got the bill. Even if it's just for a small amount, an old unpaid bill could be damaging your credit without you even realizing it. If a bill is sent to collections, it stays on your credit report for 7 years, even after you pay it off. 7 years. So it's important that you check now so you can start taking steps to figure out your next move, and if there's damage, to start repairing it. Okay, so that's your credit report. Now let's talk about how your credit score works. Your credit score is a number that represents how well you've managed all your financial obligations over time. So pretty much every bill, account, and debt that you've had in your name. Your credit score also represents your risk as a borrower. So when you go to apply for a credit card or mortgage or other type of loan, the lender wants to know what kind of risk are they taking by giving you the money. So how likely are you to pay it back? If you have a good credit score, they trust that they can give you the money and you'll pay it back on time. If you have a bad credit score, they're probably not going to give you the money, or they're going to charge you a lot more for it. To get a good credit score, you have to pay attention and keep tabs on everything so you can manipulate your score in your favor. How do you manipulate your score to work in your favor? By understanding just a few important factors that make up your score, what damages it, and how you can improve it. So let's take a look. There are 5 main factors that determine your credit score. So the first one is payment history. The first thing lenders want to know about you is whether you paid off your past bills on time. And this makes up 35% of your score, so it's the most important factor. Even if you pay bills on time now, a few late payments in the past can damage your score for a long time. So moving forward, paying all of your bills on time is the most important rule for having a good credit score. The second factor is the amount of debt you owe. The technical term is your credit utilization rate, and this makes up 30% of your score, so another really important factor. Basically, it's how much money you owe compared to how much credit is available to you. In the eyes of lenders, when you're using a high percentage of all the money you have access to in credit, it makes it look like you're overextended and that you probably can't afford to pay all that off. So to them, it seems like you're more likely to make late or missed payments. So here's an example. Let's say your credit card has a limit of $1,000. If you carry a balance month to month of $800, you're using 80% of your available credit. That's bad, because it looks like you're using the card to pay for things you really can't afford, since you aren't paying off the bill in full. So if you have multiple credit cards, just add up all the limits and look at it next to the total balances you owe on each card. So it's important to pay attention to all of your balances and pay down the total amounts you owe as quickly as you can. If you can't pay them in full, just try to get the balances down. The third factor is your credit history. This makes up 15% of your score. It's basically the total length of time that you've had credit in your name, and the longer the better. So if you don't have a credit card, get one. But of course, use it responsibly. The impact of credit history on your credit score is also why you don't want to close paid off accounts. Because when you close the account, however long you had it, you're taking those years away from your total credit history, so it reduces the length of your credit history. The fourth factor is your credit mix. This is 10% of your score. So not a huge deal in the grand scheme of things, but you definitely want to be aware of it. Your credit mix is based on the different types of credit you have. So credit cards, retail cards, mortgage, and other types of loans. And then the last 10% is based on how much new credit you have and how quickly you got it. So this is why you don't want to go apply for a bunch of new credit cards at once. It makes you look like more of a risk to lenders if you're trying to get access to a whole bunch of money in a short period of time. Sketchy, don't do that. So generally, those are the 5 main factors that determine your credit score. But how much each factor really matters will vary from person to person. You have a different credit history than I do, and we both have different stuff in our credit reports. So how each of those factors really impacts our score, that's going to be a little bit different. But you can use those main factors as a general guideline as you start to navigate your credit and figure out what to do next. For more on your credit reports and your credit score, we've got all that information at clark.com/commonsense.